Good morning, everyone. Thank you for joining us this Saturday morning as we share with you our views about the stock market. Okay, so I'd like to start by doing a recap of what I discussed 6 months ago. So 6 months ago, I said that we remain positive on the market's long-term outlook. However, it could take a while for the market to resume its upward trend because there were numerous challenges in the short term. So unfortunately, as of today, those challenges remain and have in fact increased. Okay, so first of all, one of the things I talked about 6 months ago is about how corporate earnings performance have disappointed. Um, so at the time, we've only seen the first quarter earnings performance, and as you can see, 39% of the listed companies came out with below expected earnings results. So for the second quarter, there were still 39% of companies that came out with below expected earnings results. The third quarter was better. You have 33% of companies coming out with below expected results. Okay, but the bad news is one of the reasons why it was less is because, as you can see, the EPS growth forecast has also declined from 17% during the start of the year to 7.5, meaning that a lot of people had tapered their growth expectations. Okay, another bad news. Well, China continues to weaken. There are already some signs earlier during the year. But of course, now, if you read the papers and watch the news every day, they talk about how China is weakening. And as you can see, the GDP growth has been on a downtrend, and the latest number was 6.8%. Okay. The PMI, which is a measure of growth, anything above 50 indicates growth. Anything below 50 indicates a contraction. Um, the latest number is 49.7. So it's also indicating contraction on the manufacturing sector of China right now. Okay. And then this is something that I shared with you, I think a year ago about liquidity and about how, I mean, if you look at the whole world, it seems that only the US is increasing interest rates or tightening its monetary policy. So as you can see, since the last time we spoke, China has done so many other things to, increase its money supply. It has cut interest rates 5 times, okay, by 125 basis points. It has cut its reserve requirement ratio, okay, and then Europe as well has done more things. On the other hand, the US, after it did its removed its QE, it has also raised interest rates once last year in December. And for this year, there are expectations that they will be increasing interest rates by a total of 100 basis points or 4 times. Okay, so they will be doing this on their own, regardless of what is happening to the rest of the world. So that is the expectation. Okay. And unfortunately, because of what is happening to China and what is happening to the US, this is what we're seeing. Okay, first is a strong US dollar. So the dollar has appreciated against the basket of currencies by around 35.7% from the low. And commodity prices are falling. The basket, it's not only oil prices. Oil prices are actually down by 75% from their peak of more than $100 in 2011. But all commodity prices are actually falling, and the CRB index, which measures a basket of commodities, is actually down by around 35% from its 2011 high. Okay. And while, if you look at this global map, the Philippines is actually doing very well. So just a guide on how to look at this map. Countries in color green are countries that are benefiting from low commodity prices. So the Philippines is really very small there, as you can see. we are color green. So we're benefiting from low commodity prices. Unfortunately, if you look at the number of countries that are turning red because of falling commodity prices, or the countries that are vulnerable, they are quite a bit. Okay, and I mean, if you can classify them, most developed economies are benefiting. Okay, you have the US, you have Europe, among the developing countries, you have India, and well, China can be developing, depends on how you look at it. But then most of the other countries around the world are suffering from high commodity prices. And why do commodity prices matter to developing economies? So these are just some numbers for you. Okay, so first of all, 57%. What is 57%? It's the increase in the value of commodity exports from 2009, 2010 to 2011 to 2013 for developing economies. Okay, they greatly benefited from rising commodity prices, and they've actually increased commodity exports. Okay, 71% is the percentage of developing countries that derive more than 60% of their exports from commodities. So as you can see, a large portion of developing economies are very dependent on commodity exports. Okay, so if we talk about least developed countries, those that are even poorer, 85% derive more than 60% of their exports from commodities. Okay, and as discussed earlier, 35% is the average drop in commodity prices. So can you imagine if you derive 70% of, more than 60% of your exports from commodity prices, and that drops by 35%. That's a big impact on your exports. And 74% is the drop in oil prices, okay, which is quite significant. Okay, so this table just shows you a selected number of developing economies as defined by several multilateral agencies. Okay, so I just got some statistics on them. So their commodity net exports as a percentage of GDP, and current account as a percentage of GDP. So current account just measures the amount of dollars that you earn versus the amount of dollars that you spend. So obviously, if it's positive, it means that you're very strong, and you're not vulnerable even to a strong dollar. But if it's negative and the dollar strengthens, you get into trouble. That's what happened to the Philippines in the 1990s when we had the Asian financial crisis. We didn't have a lot of dollars, so of course when we had the Asian financial crisis, the peso depreciated significantly. Okay, and on the commodity net exports, if it's positive, it means that if commodity prices fall, um, you will be hurt significantly. So as you can see, a lot of countries are vulnerable to falling commodity prices and a strong US dollar. Okay? So if you look at the list, China is not vulnerable, Philippines, Thailand are not vulnerable, but the rest are vulnerable one way or the other. Okay? Okay, so although, earlier on, it's relieving to know that we aren't that vulnerable. Nevertheless, um, we can't help it. We still are being affected. Okay, it's just that we're not being affected as much. And one of the warning signs that we kind of noticed late last year was our OFW remittances. In the past, I've always said that even during the global financial crisis, it was quite amazing how our OFW remittances remained resilient and have not gone down in value. So you can see in '09 how our OFW remittances remained strong. And, when our OFW remittances started showing signs of a slowdown during the second half of the year, as you can see here, July, it's up by only 0.5. August, it's down by 0.6. Okay? If you read the papers, one of the things they say, it's because of the depreciation of the peso. But if you look at 2009, the peso depreciated by 15%. And, to date, it's, or 2015, 2014, it's down by around 4.6%. So, there's a disconnect. You cannot use that as a valid argument. There might be something wrong. Okay, so this is one of the things that, made us look a bit deeper. Are we more vulnerable? And one of the risks that we think we should take a look at is our exposure to the Middle East. Okay, so currently, every year there are 2.4 million Filipinos being deployed um, as OFWs. Okay, comprised of 1.9 million land-based workers and around 500,000 sea-based workers. And 61% of those land-based workers, or 61% of 1.9 million, go to the Middle East. Okay? And in terms of the value of OFW remittances, so every year we get around 24 billion US dollars, and 23% come from the Middle East. Okay, so now let's talk about the Middle Eastern countries. Okay? The current account to GDP of Saudi Arabia is 10%, which is great. It seems like they are resilient to the strong US dollar. However, their dependence on commodity exports is very high at 24% of GDP. This is net of imports already. So recall earlier on, I talked about how oil prices have fallen 74%. So if you get your exports is 24% of GDP and then you minus 74% of it, it means that you're going to be affected by around 17, 18%. So your current account surplus is only 10% of your GDP, but your exports are going to drop by 18% of GDP. So you're going to have problems now with your dollars. Now remember that the Saudi riyal is pegged to the US dollar at 3.75 since the 1990s, I think, or 1980s. Okay. Now the major problem is, you know, will Saudi Arabia abandon its currency peg to the US dollars? So of course, one threat because of our big exposure to the Middle East is that our OFWs might lose their jobs, a big number of them. And another problem might be that those that remain in Saudi, they will earn much less in dollar terms as Saudi may abandon the peg to the US dollar. Okay, our peso is also weakening. So it's quite clear after hitting a low of 40.581, it has depreciated to 47.78. This is brought about by a mix of internal and external factors. Internally, our balance of payment surplus is actually deteriorating because remember, since 2013, we started suffering from fund outflows. Foreign investors became jittery. Philippines being grouped together with other Asian countries, they started selling Philippine assets as well, regardless of our fundamentals. Another problem that came about recently was the Chinese yuan. Chinese yuan has also started to depreciate. Okay. And our interest rates are going up. Okay. It hasn't gone up quite significantly yet, but you can see that there is some pressure for it to go up. And what are the factors that are pushing up interest rates? First, there's anticipation of a rate hike by the Fed. So as discussed earlier on, the Fed is anticipated to increase interest rates by a total of 100 basis points in 2016. Okay, then we have the weak peso, and then finally, in the second quarter of this year, the BSP is expected to implement the interest rate corridor. So there's much uncertainty on how that will be implemented and how it will impact interest rates. Okay. And unfortunately, a weak peso and higher rates are not good for the stock market. So if you look at the chart on your left-hand side, you will notice that when the peso weakens, the stock market also weakens. And when the peso strengthens, the stock market also strengthens. So the stock market is the orange line, the peso is the blue line. Okay, so there seems to be this relationship between forex and the stock market. And as far as interest rates are concerned, I mean, one of the reasons why our stock market has gone up is because of falling interest rates. Okay, that has allowed the market to trade at much higher valuations than in the past. Now that interest rates are going up, of course, we can expect some sort of derating to happen. For those that read our research reports, we have earlier this year talked about increasing our risk-free rate assumption and how that has led to a reduction in our fair value estimates. Okay, elections are also hurting sentiment. You know, if you talk to foreign investors, they actually want Mar Rojas to win because they feel like he will continue the daang matuwid. Okay, and there's less uncertainty because he is the administration candidate. Okay, the problem is he's not getting good numbers in the polls. Okay, so I mean, if I were a foreign investor and that is how I feel, then obviously I just stay on the sidelines and wait for the elections um, to finish first before I come back and take a look. Okay, so the major correction that we were talking about last year is now threatening to become a bear market. So by definition, a bear market is a situation wherein the market is down by 20% from the high and stays at that level for 2 months. So we are already down by 23%. If you look at the line in the chart, we are the blue line. Initially, we were performing better than our ASEAN neighbors. But recently, we have caught up and we are already down by 23%. Okay. I mean, I guess um, in summary, it's just that there are so many challenges facing the country right now that it's making it difficult for us to fight contagion. It's quite clear that our other neighbors have more problems than we do, but then again, um, it's becoming harder for the Philippines to fight contagion because we also have certain risks and uncertainties that um, investors don't want to, or we don't know what will happen.